I'm Greg Liska with Iron Point Financial, and welcome to Part 3 ETFs, also known as exchange traded funds. So, as the world has changed, the investment landscape, the technology has changed. Out of that has been this evolution that has brought about the ETF. Now, an ETF is another investment vehicle that can be as broad or narrow as we want. You can have actively managed, professionally managed, meaning somebody's behind the scenes trying to squeak out as much return as possible. And we can have passive ETFs that just follow an index. You've probably all heard of the S&P 500, the Dow, maybe the Russell. There are a lot of different indexes out there. And if we want to just follow the S&P 500, well, we can do that. And one of the strengths of an S&P 500 is that you can do that on a very cost-effective level, where a mutual fund that may be looking to benchmark itself against the S&P 500, which is a domestic, those are the 500 biggest companies on the domestic market, okay? So that mutual fund may have an expense ratio anywhere from 50 to 75 basis points, meaning a half to 3/4 of 1%, okay? So you may be able to get that same tracking of that benchmark for 3 or 4 basis points, meaning 3 or 4 hundredths of 1%. So 0.0003 versus 0.006, say. All right? So that is one of the big differences. And you can get passive or active. Those passive funds can be incredibly cheap, right? And one of the narratives that's often pushed, I hear quite a bit, is that, boy, Greg, it's just really hard to beat an index. In some cases, that's true, right? Not always, and we could show you how that's done. But if that's the philosophy that we want to run under, we have that solution for you. Just get a passive ETF, and we can track less the expenses, whatever index you're looking for. Okay. Now we do have what are called smart beta ETFs. So that would be an ETF that has an actively managed part component to it, right? Certainly more expensive than that passive ETF that is just tracking an index, certainly. But if we're looking at investing, to me, it's don't get caught up in the expenses. Cheaper is always better. Lower expenses can help, but at the end of the day, show me the bottom line. Show me the money, to borrow a line from, I believe that was Jerry Maguire. So show me the money. Net, how much money did we make at the end of the day? That's truly where the rubber meets the road. So it's a great way to do it. It's this ever evolving. It's the new kid on the block, about the same time as you in an investment trust. But we can be very broad. We can be very niche oriented. There's a lot of different things we can do in there. But that is an overview of ETFs. Look forward to seeing you in the next video.